Hey guys, Werner with the Red and Black Academy, and today I'm coming to you from sunny Los Angeles, and I want to talk to you about bonds. Bonds, and bonds 101 specifically. What is a bond? Why is it important? How does it work? Now, for you individuals that are seasoned investors or businessmen, you already know about bonds, then disregard this video. But if someone else could get value from this video, like one of your nieces or nephews or sons or daughters, please share this with them. Okay, so let's get started. So what is a bond? A bond is a debt instrument. It pays a fixed income for the debt that's raised. So to talk about it real succinctly, because I hear a lot of people when they talk about bonds, they talk about bonds after they've already been issued, and it can get kind of confusing, meaning, a bond was issued in 2021, and now people are trying to describe the bond in 2022 or 2023. It's at this yield, this and that, and it confuses people. So here's how I want you to think about it. I want you to think about a company, say Oracle, and they raise, let's just say, $1,000, right? They have $1,000 bond, right? So they raise $1,000, and that bond pays $100 per year. Simple, just one bond, $1,000, $100 per year. So what's happening there? Someone is giving Oracle $1,000, and then Oracle is giving that individual a 10% yield. This is the first date of issue of the bond, from Oracle to the individual that lent the money to Oracle. So they're getting $100, the individual that lent the money, and Oracle is paying $100. So that yield is 10%. Now what happens is that bond then can be traded out in the market. So say I lent that money to Oracle, that $1,000. Now let's say the bond market for Oracle, they're like, someone's willing to pay $1,100, so $1,100. Oracle's still paying for the life of that bond, say 10 years. Oracle's still paying the $100 year in and year out. They still pay $100. It does not change. This is what's called fixed income, right? So that bond, the individual that just bought it, well, they took $1,100 and gave it to me, right? And I made $100 extra. They took $1,100, and now they're still getting paid $100 from Oracle. So you divide 100 by 1,100, and you get a percentage rate or a yield that's below 10%, because that $1,100 is still getting $100, right? So the yield goes down. That's how the yields work. So if the price is going up, the yield's going down, because Oracle at the beginning always sees it as a $1,000 bond. I'm paying you $100. Where you buy it depends on what your yield is, because you're still that bond. Imagine when you buy a bond, you're getting a fixed payment coming to you. So $1,100, the interest rate goes down. If you go down and pay $800 for it, well, now you're getting $100 for $800. Now you're getting 100 divided by 800. That's a higher percentage. That's how bonds work. And all bonds is money loaned to a corporation or a business or an individual. There's no ownership in the bonds. But the bond markets are massive. They far outweigh the equity markets. Why is this important to know? Because this channel is all focused on how do you create cash flow. And fixed income is not a bad way to create cash flow if you're in an environment where they're maybe paying 8-9%, because for 10 years, I'm going to park my money here and I'm just going to get 8 or 9%. Now, all the analysis that I talk about in other videos applies here, because you want to know if you're going to lend your money to a publicly traded business, they're going to be around for 10 years. They're going to be able to pay that bond out or that yield out. That's where it gets into like junk bonds and higher rated bonds, right? Which we won't get into in this video. But supposedly, the higher rated bonds nowadays are going to pay out for years to come. You want to do your own due diligence. Don't trust Moody's or any other financial institution to tell you what the rating of that bond is. Go do your analysis. See how healthy the business is, like I've talked about in other videos. Are they a 20% operating margin business? Do they pay you to own it? And will they be around for the long term? But that's it, guys. That's the bond. Wherever you buy a bond, it's always going to pay the same $100 or $50 every year, like clockwork. So if you buy it lower than the par value of the bond, then you're going to make a higher yield, and higher you're going to make a lower because it's paying that same amount. I hope that helps, guys. If that doesn't make sense to you, leave a comment in the comment section with a question. If you love this video, like, comment so I can share it with the world. And as always, it's a pleasure getting to be with you, and I look forward to connecting with each and every one of you in the future.